Hey guys! We are your accounting guardians. Today, we are going to teach you about non-current liabilities. So let's get started! So to start off, let us first define non-current liabilities. Remember the following. As a general rule, a currently maturing obligation or an obligation that is payable on demand is presented as current. The following exceptions will result to non-current classification. First, refinancing is completed on or before the balance sheet date. Second, refinancing agreement takes place after the balance sheet date but before the financial statements are authorized for issue and the entity has the discretion to roll over the liability on a long-term basis. And lastly, grace period to rectify a breach of agreement is received on or before the balance sheet date. Notes payable are obligations supported by debtor promissory notes. The accounting for notes payable is similar to the accounting for notes receivable. So you must be confused. What are promissory notes? A promissory note is an unconditional promise in writing made by one person to another, signed by the maker, engaging to pay on demand or at a fixed or determinable future time a sum certain in money to order or to bearer.
There are 4 types of notes payable. 1. Short-term payables. 2. Long-term payables with reasonable interest rate. 3. Long-term non-interest-bearing payables. 4. Long-term payables with unreasonable interest rate. Example of a short-term note, interest deducted in advance. Lump sum. Here is the problem. On July 1, 20X1, ABC Corporation issued a 1 million note payable for money borrowed from XYZ Incorporation. The 1-year, 1 million note payable was discounted at 12% and is payable in lump sum on June 30, 20X2. The entries for this problem is as follows. On July 1, 20X1, we debit cash on hand of 880,000. We debit discount on note payable at 120,000 and we credit note payable at 1 million to record the note payable discounted. On December 31, 20X1, we debit interest expense at 60,000 and we credit discount on note payable at 60,000 to record interest expense. On the following year, on June 30, 20X2, we debit interest expense at 60,000 and we credit discount on note payable at 60,000 to record interest expense. On June 30, 20X2, we debit note payable at 1 million and we credit cash in bank of 1 million to record the settlement of the note payable. So this is how we compute for the carrying amount of the note payable. The carrying amount of the note at maturity date on June 30, 20X2 is equal to the face amount of 1 million because of at this date, discount is fully amortized. The entry to settle the note at maturity date involved debiting notes payable and crediting cash at the face amount.
Here's an example of a long-term note with reasonable interest, simple interest. On October 1, 20X1, ABC Corporation acquired land by issuing a 2-year, 12%, 1 million note payable. Principal is due on October 31, 20X3, but interests are due annually every October 1. ABC uses the calendar year as its accounting period. The pertinent entries are as follows.
Here's an example for non-interest-bearing note installment. The problem is, on January 1, 20X1, Maganda Company acquired transportation equipment in exchange for cash of 100,000 and 1 million. Non-interest-bearing note payable due in 4 equal annual installments starting December 31, 20X1. The prevailing rate of interest for this type of note is 12%. So first, we should compute for the present value of note payable on January 1, 20X1. So to compute for future cash flows, annual installment, we should divide 1 million divided by 4 equal annual installments equals to 150,000. So we should multiply the present value of an ordinary annuity of 1 peso at 12% and is equals to 4 years, which is equals to 3.0373. Then we should multiply both future cash flows and present value. So the present value of note payable for January 1, 20X1 is 759,337. So the journal entry for this computation is So, this is the amortization table for the whole installment. So, the present value for January 1, 20X1 is 759,337. So, the fixed payments for December 31, 20X1 up to December 31, 20x4 is 250,000. So to compute for the interest expense, we should multiply the present value times the prevailing rate of 12% to get 91,120. To find the amortization, we need to deduct the payment of 250,000 to the interest expense of 91,120 to get 158,880. So to get the present value for December 31, 20x1, we should deduct the previous balance of the present value to the amortization to get 600,458. Same goes for the preceding years with a decreasing present value. The end of the installment value should be 0. So these are the entries.
Long-term payable with unreasonable interest rate. On January 1, 20x1, Walang Susuko Corporation issued a 3-year, 3%, 1 million note payable in exchange for a machine. Principal is due on January 1, 20x4, but interest is due annually every January 1. The prevailing interest rate for this type of note is 12%. To compute for the present value of the note, the future cash flows are first identified, then multiplied by the present value factors. Here is the amortization table. The pertinent entries are as follows.
So now, let's move on to bonds payable. What is the definition of bond? A bond is a contract of debt whereby one party called the issuer borrows funds from another party called the investor. A bond indenture is the contractual arrangement between the issuer and the bondholders. It contains restrictive covenants intended to prevent the issuer from taking actions contrary to the interests of the bondholders. Bonds are accounted for in much the same way as notes and loans payable. However, bonds normally are long-term, bear interest, issued at a premium or discount, and entail transaction costs. So now, let's distinguish what are bond premium and discount. Example of the problem in bonds issued at a discount. On January 1, 20x1, ipasamo na kami, corporation issued a 1 million bonds and a 10% 3-year for 951,963 pesos. Principal is due on December 31, 20x3, but interests are due annually every year end. The effective interest rate is 12%. To find out how much is the discount on bonds payable, we compute as follows. The face amount of bonds is 1 million. The cash proceeds is the issue price, which is the 951,963 pesos, and we deduct both of them. We get the discount on bonds payable of 48,037. There is a discount because the cash proceeds is less than the face amount of the bond and the effective interest rate is greater than the nominal interest rate. The first entry of the issuance of bonds is as follows. The amortization table is presented. Notice that the amortization of the discount increases periodic interest expense. When bonds are issued at a discount, the cash received is less than the obligation incurred. In effect, there is a loss. However, such loss is not recognized immediately, but rather deferred and amortized as an addition to periodic interest expense. The other pertinent entries are as follows.
Moving on, here's an example of bonds issued but now premium. On January 1, 20x1, Kakayanin Corporation issued 1 million payable, 12%, 3-year bonds for 1,049,737 pesos. Principal is due on December 31, 20x3, but interests are due annually every year end. The effective interest rate is 10%. The premium on bonds payable is computed as follows. The cash proceeds, which is the 1,049,737 minus the face amount of bonds, which is the 1 million pesos, would result to 49,737, which is the premium on bonds payable. The entry to record the issuance of bonds is as follows. On amortization table, notice that the amortization of premium decreases periodic interest expense. When bonds are issued at a premium, the cash received is more than the obligation incurred. In effect, there is gain. However, such gain is not recognized immediately, but rather deferred and amortized as a reduction to periodic interest expense. The other pertinent entries are as follows.
Accounting for transaction costs. Just like for transaction costs on the issuance of loans, transaction costs incurred on the issuance of bonds are included in the carrying amount of the bonds and amortized using the effective interest method. Issuance of bonds in between interest dates. When bonds are issued in between interest dates, any accrued interest prior to the issuance date is sold to the investor together with the bonds. Treasury bonds are an entity's own bonds which were originally issued but subsequently reacquired but not cancelled. Bond refunding refers to the issuance of new bonds, the proceeds from which is used to retire existing outstanding bonds. An example of retirement of bonds. On January 1, 20X1, NISCA Corporation issued a 5-year 12% 1 million peso bonds for 1,075,816 pesos. Principal is due at maturity but interests are due annually. The effective interest rate is 10%. On July 1, 20X3, NISCA called in the entire bonds and retired them at 102. The retirement price includes payment for accrued interest. An amortization table is prepared up to the date of retirement. The entry to update the carrying amount of the bond on July 1, 20X3 is as follows. The entry to record the extinguishment of the bond on September 30, 20X1 is as follows.
So that's it, guys. Hopefully you learned something from this tutorial video. If you are struggling, always remember that there's a solution to every problem. Thank you very much. Push lang te!